Hello and welcome back to another lecture video dealing with chapter 14. In this video, we're going to discuss learning objective 3, which has to do with preparing and analyzing a comprehensive stockholders equity section. Okay, so the first thing that we need to kind of remember and go back and think, back in accounting 1, we looked at the owner's equity section, right? And we said that owner's equity section really was made up of, the owner's capital account, the owner's draw account, and that main account that we had, retained earnings. So when we looked at it from the standpoint of whether it be a sole proprietorship or a partnership, the owner's equity section was very, very, very small, right? Then we come into accounting 2, and we started talking about stocks, right? Chapter 13, our last chapter, we went through how to record stock transactions, right? We talked about the treasury stock. Remember, treasury stock is the stock that the company buys back from the market. I'm going to go ahead and just assume that a lot of you are watching the news, and I saw today specifically Trump was talking about a stimulus package for handing money out to get the economy going for people that are locked away in their homes, that aren't able to go to work. They need some money, right? So there was one reporter I remember asked a question about stock buybacks. Well, that stock buyback, that references the treasury stock account that we have been working with, what we worked with, 2 weeks ago, 3 weeks ago now. So I think it's kind of interesting that, we talked about treasury stock and buying back stock off the stock market. A corporation buys their own stock back, and if you watch the news, that has a impact on the stock price, right? It raises the price as there's all these shares floating around out there. The company says, we're going to buy back our own shares. What does that do to the market? It increases the share price. And I remember in the news conference, or the whatever he was talking about, I guess it was a news conference. They interviewed him, and they says, what about these stock buybacks? And, I remember him saying that, that's not the point of the stimulus package. The point of the stimulus package is not to impact a company's stock per se. The main reason for the stimulus package is to get the money into the hands of, small businesses, get it into the hands of, get it into the hands of people that actually need the money. So as we're looking at retained earnings, let's bring it back to retained earnings. I apologize about that. So retained earnings, remember what it is. It is the net income that the company retains in the business, right? We said, and for those of you guys that had me for accounting 1, we said that, excuse me, we said that think of retained earnings as a bucket that holds all the net income that the company has made over its life, right? So we know what the retained earnings is. It's that net income, which is very important. So you should definitely put that in your notes. Put that on a note card. Study it. You got to know what retained earnings is. Hopefully you know what it is by now. If not, it's your second opportunity to commit that definition to memory. So as we go deeper in looking at retained earnings, part of retained earnings is made up of two things, Part of it is the stockholders' claims on the total assets of the corporation. What in the world does that mean? Well, think about it. Stockholders are owners, right? Retained earnings part of retained earnings rather, is the owner's claim to those assets of the business or of the corporation, okay? Debt balance and retained earnings, that means that we have a deficit, okay? So if you notice the bottom of the slide here, we have a portion of the balance sheet, right? And we have our stockholders' equity section. And again, very important, we know how to put together the stockholders' equity section. So as we look at this, keep in mind, look at all the titles that we have. Look at the accounts we have, right? We have the overall header of stockholders' equity. And then underneath that, we have paid-in capital. Remember, paid-in capital is made up of two things, right? Common stock, and we don't have it in this example, but we've seen in the past, the other part of that paid-in capital is that additional paid-in capital in excess of par common, right? So if you notice here, after we get to the paid-in capital section, the next title is that retained earnings, right? And if you notice, here we have it as a negative. When we're dealing with balance sheets, financial statements, whether it's a balance sheet, income statement, statement of owner's equity, we don't use debits and credits, right? We just have to know if we see a positive number, that positive reflects, is it a debit balance or a credit balance? And again, that depends on what kind of account it is, right? If you notice here, we have a negative $50,000. Because we're on the balance sheet, we're in the negative, right? That's how we tell, or that's how we communicate to investors that our retained earnings is in the negative, okay? Now, keep in mind, the bullet point says debit balances and retained earnings is identified as a deficiency or a deficit, right? Nowhere in this little balance sheet that we're looking at do we see a debit or a credit, right? We just have to put those parentheses around it saying, yep, it's in the negative, okay? So when we look at retained earnings, right, there are some restrictions to retained earnings. Well, what do we mean by that? Well, what we mean by retained earning restrictions, these are restrictions that happen or that are put upon a company. They're either a legal restriction, so they're imposed on the company, right? You have to have X amount of retained earnings. It could be a contractual restriction, right? Things like debt covenants and things like that could be a reason why there's a restriction on our retained earnings, right? There has to be so much owner contribution, and the owners can't take out all their cash and leave the and not leave anything left for the debt holders, right? It's kind of that idea that, okay, owners, you're last to eat, right? First, we got to pay back the debt holders, right? Who we have, who we borrowed money from, whether it be banks or bonds, things like that. Okay. And then finally, there's a voluntary restriction, right? A company can voluntarily restrict their retained earnings, meaning we're going to have a balance of Y, and we're not going to go below that for any reason. And this is just a voluntary restriction. So you see here a kind of a real world example here for Tectonic Incorporated, right? And notice that this is a note to the financial statement. So on their balance sheet, they're going to have notes, right, underneath. And it says here that certain of the company's debt agreement requires compliance with debt covenants, which I mentioned earlier. Management believes that the company is in compliance with such requirements. The company had unrestricted retained earnings of $223.8 million after meeting those requirements. Okay, so when you read this, what are we getting from this? Well, we're getting information, obviously, but we got to decipher that information. They're not saying that our retained earnings is $223.8 million. They're not saying that the debt covenant says that we must maintain that threshold. What they're saying is we have retained earnings. We have some debt covenants. We don't know what those debt covenants are. We don't in this example because they don't tell us, right? But what we do know is that we have that X. That X represents that debt covenant that says retained earnings has to be X amount. What they're saying is the company has unrestricted retained earnings of $223.8 million. So that means whatever the total retained earnings account is, we don't know what it is. We do know that of the total, $223.8 million is unrestricted, meaning they could use that to pay out a dividend and still be within their legal restrictions based on that debt covenant. Okay? So we need to look at retained earnings. Now, we really didn't get into corrections of an error yet, right? But a lot of times in the real world, you will see this. We have to make an adjustment, right? Meaning we reported something on a prior year that wasn't correct. It wasn't malicious. We didn't do it intentionally. It was just a mistake that was made, okay? So once we catch that mistake, guess what we need to do? We need to correct that mistake. How do we correct that mistake? Well, we hit our retained earnings account, okay? So any prior period adjustments that we have to make, 2 years ago, we said our net income or our income was $2 million. Well, we made a mistake. We calculated the math incorrectly. And instead of having $2 million of revenue, we had actually $190 million of revenue. 2 years later, we uncover that mistake. We got to go back and restate it. Okay? So that's the takeaway for right now. Okay, we'll get in later the journal entries and the logic behind that. But for right now, just know that we use retained earnings to make corrections of errors. Okay, that based on previously reported financial statements. So where do these mistakes come from? Well, like I said before, it was a mistake, right? Mathematically, we did something wrong. We didn't carry the one. We fat fingered a key. Whatever. Another reason for a mistake that could result in a prior period adjustment would be we didn't apply the accounting principles properly. We should have capitalized something and we expensed it. Okay, well, that's okay. You caught the mistake, fix it. And then the final reason for any retained earnings prior period adjustment might be an oversight or misuse of a fact. So basically, all we really need to worry about is if we have a prior period adjustment, we have to make an adjustment to the beginning balance of the retained earnings. Okay? So let's look here at a quick example. So we have Wood Incorporated. They give us the statement of retained earnings. Okay? So let's quickly review what is on the statement of retained earnings. Well, that statement of retained earnings is trying to get us to prove what our ending balance is of retained earnings, right? Remember, things like net income increase retained earnings. Things like net losses and dividends decrease retained earnings, okay? So in this specific example, beginning January 1 of 2017, our retained earning balance was $1,050,000. Cool. We go through the entire year, and at the end of the year, we have to report what is our retained earnings. Well, we need to think back. We need to think back over the year. We need to look at pretty much our financial statements, and we need to say, okay, well, we made net income. That's obvious from the income statement. Well, remember, net income increases retained earnings, okay? So we're going to add that to our beginning retained earnings balance. Well, we also paid some dividends throughout the year. No problem. That dividends that we paid, that amount is decreased from the beginning balance of retained earnings. So we see that at the end of the year, we have a balance as of December 31st, 2017. Retained earnings is $1,110,000. Okay. So notice what happens here. It says before issuing the before issuing the report for the year ended December 31st, 2017, you discover a $50,000 error, net of taxes, that caused the 2016 inventory to be overstated. And remember, what happens if we overstate our inventory? Well, by overstating our inventory, that makes our cost of goods sold lower than what it actually is. So since our cost of goods sold is lower than what it should be, the net income is higher in 2016. That's incorrect. Okay, we found this out in 2017, the end of 2017. So this mistake that happened actually impacts the statement of retained earnings in 2017. Why? Well, because the beginning balance is too high. We keep that, and that was a result of 2016. We started the year with retained earnings being too high. At the end of the year, retained earnings is still too high because of that error we had in 2016. So what we need to do then is we need to go ahead and fix this, right? So how exactly are we going to fix this, right? Well, the first thing is we need to remember the debits and the credits of retained earnings, okay? If you do not know this, and when I say if you don't know this, I mean you can't rattle this off the top of your head. Put it on a note card, memorize it, okay? So retained earnings, right? Things like net losses, prior period adjustments for overstating net income, any cash dividends, stock dividends. Maybe there's we dispose of treasury stock. Those are going to be debited to retained earnings. Okay, why? Because that decreases retained earnings. Look at the credit side of it. Well, net income gets a credit. Prior period adjustments for understating net income gets credited. Okay, so think about it this way. And again, I can't mention this enough, right? What is accounting? Well, it's obviously record keeping, but we need to keep a chronological order. What happened first, what happened second, what happened third, fourth, fifth, and so on, okay? Very important that we remember that chronological order, okay? What we're saying is we made a mistake previously, and the result of that mistake said that we overstated our income, our net income. Our net income is higher than it actually should have been. Later on down the road, today, we say, oh man, we made a mistake 2 years ago and we overstated our net income 2 years ago. Well, because of the nature of retained earnings, because it's a permanent account, it's a bucket that holds all the net incomes of the company since its existence, right? Because of that fact, our retained earnings is overstated. We need to decrease our retained earnings. How do we do that? With a debit. Flip side, we made a mistake prior, right? In a prior year, we understated our net income, meaning we understated our net income. We should have had more, but we made a mistake and we're reporting less than we actually made, okay? Again, a year or two, whatever, down the road, we catch the mistake. We realize that 2 years ago we made a mistake. We understated our net income. 2 years ago, we didn't put enough net income into retained earnings. We're here today. We caught the mistake. Let's fix it. We need to increase our retained earnings. Okay? So let's look at an example. Excuse me. So we have Graber Incorporated. It's the retained earnings section of their balance sheet. Notice what we have first. The beginning balance, January 1st, as reported, it was $1,050,000. Let's go back here. Okay? This is what these are the numbers that we're working with here. Okay? So we're starting off with the $1,050,000. We have a correction for the understatement of net income in a prior period, right? We said our net income should be higher than it actually is. We had that inventory level, right? So we need to fix it. How are we going to fix it? We're going to hit our retained earnings for 50,000, or I'm sorry, we're going to decrease our retained earnings for 50,000. Then we get to our adjusted beginning balance of $1,100. Okay? So again, going back here, we're looking and we're saying that, hey, you discovered that $50,000 error. Inventory was overstated. We overstated inventory. As a result, cost of goods sold were lower. As a result, the net income to be higher in 2016 than it actually should have been. Okay? So, once we get our balance, adjusted balance or adjusted beginning balance, we go ahead and create the income statement, the retained earnings statement, adding net income, subtracting out any cash dividends or any stock dividends that we paid. Okay? What we have here is the portion of the balance sheet of stockholders' equity. Okay? Again, study this. You got to know how to put one together blind. Well, what does that mean? Well, what I mean by that is if you have the information visually in your head, you know how to put together the stockholders' equity section. You start off with the first heading, stockholders' equity. Then we have the second section, paid in capital. Okay, well, we're going to list our capital stock. We're going to list the preferred. We're going to list the common, right? We're going to list any dividends that we distributed. We're going to get our total capital stock. Then we're going to go to the next section of the paid in capital, which is what? Additional paid in capital in excess of par. We have one for the preferred stock. We have one for the common stock, right? Then we add together the common stock that we have and the additional paid in capital that we have. We end up with the total paid in capital section. The next section is our retained earnings, right? So we go ahead and add in our retained earnings. And then we have the total paid in capital and retained earnings section. If we would ever repurchase any treasury stock, we would subtract that out. And we end up with our stockholders' equity section. Okay, so the main takeaway here again is recognizing the parts and being able to put those parts together. Paid in capital has two pieces, right? It has the common stock. It has the additional paid in capital in excess of par. That's one part of stockholders' equity, right? The other part of stockholders' equity is that retained earnings. Okay. We'll worry about the return on common stockholders' equity to the end of the class. What we're going to do is once we get to the end of the course or closer to the end, we're going to do a week of analysis, and we're going to run through all the analysis that we can do. Okay, so instead of just putting it arbitrarily in, we're going to wait till the end and just go back and look at everything. I think that'll make it a little easier for us. Okay. When we come back in our next video, we're going to do an example of the retained earnings statement, and we're going to do it out of the textbook. Okay. So tune back in where we look at look at a demo video of working with retained earnings. So thanks for tuning in, and we'll see you in our next video.